Ever wonder how some companies, almost silently, pivot and transform their entire identity right under our noses? They evolve from what they once were into something completely different, often more resilient and, well, strategically powerful. Today, we're embarking on a deep dive into a fascinating case study of just such a company. We're going to pull back the curtain on Applied Industrial Technologies, Inc., or AIT. Now, it's a name you might not immediately recognize, but trust me, it's a company that plays an absolutely crucial, often unseen role behind the scenes of countless industrial operations. Think of them as the unsung heroes, the vital connectors and problem solvers, keeping the industrial world humming, from your local factory floor to global supply chains.
And our mission today is precisely that, to unpack AIT's deliberate strategic transformation. We're looking at their evolution from what was once more traditional, perhaps commodity-focused industrial parts distributor into a higher margin, technically focused solutions provider. We'll explore the ingenious ways they're achieving this, what it means for their financial health and stability, and crucially, what the future holds for this intriguing industrial powerhouse. All of this will be grounded in the comprehensive investment analysis and research you've provided us.
That's right. We've got a comprehensive investment analysis report in front of us. It's packed with detailed financial data, strategic breakdowns, and invaluable market insights. For us, it's like having an all-access backstage pass to understand how a major industrial player not only operates, but truly innovates and adapts in an ever-changing landscape. It really lays out the blueprint of their strategic vision. Over the next little while, we'll be exploring their unique and evolving business model, dissecting the complex competitive landscape they navigate, revealing their impressive financial resilience in what can be a cyclical industry, and uncovering how they're strategically positioning themselves for sustained growth. So if you've ever been curious about how industrial giants aren't just sitting still, but are actively evolving and staying ahead of the curve, you are absolutely in the right place for this deep dive. So let's begin at the beginning, shall we? Who is AIT at its core? This company has some serious history, founded all the way back in 1923 as the Ohio Ball Bearing Company. That alone tells you they've been around the block. Today, they've clearly grown far beyond just ball bearings, becoming a prominent value-added distributor and technical solutions provider, still headquartered in Cleveland, Ohio, and trading robustly on the NYSE under the ticker AIT. What immediately jumps out from the report is their sheer scale. For fiscal year 2025, they reported net sales of $4.6 billion. With operations spanning approximately 600 facilities. That includes a dozen large-scale distribution centers, predominantly concentrated across North America, but also with a significant international footprint. Places like Australia, New Zealand, Singapore, and Costa Rica. That's a truly massive and deeply entrenched operational footprint.
It's precisely that foundational scale and deep historical presence that's so fascinating. It hasn't just been a static asset. They've actively leveraged it to facilitate this very strategic evolution we're discussing. Their value proposition has moved well beyond merely distributing products. They're now focusing intensely on optimizing their customers' most critical capital equipment and production infrastructure. This isn't just about providing a replacement part when something breaks. It's about proactively ensuring a machine runs at peak efficiency, preventing costly downtime, or optimizing an entire production line to boost output and reduce waste. This level of engagement directly impacts a customer's operational efficiency and ultimately their return on capital. To achieve this, AIT deploys deep technical expertise, comprehensive service capabilities, and robust aftermarket repair and support. This strategically positions them as an integral partner, almost an extension of their customers' engineering teams, rather than just a transactional supplier for their most valuable assets. They're embedding themselves deeply, making themselves indispensable.
Okay, that clarifies their evolution beautifully. The report refers to this as a deliberate strategic transformation, a conscious shift from a traditional parts distributor to a higher margin, technically focused solutions provider. This sounds like far more than just a tweak. It's a profound shift in identity, almost like shedding an old skin for a completely new, more advanced one. But how truly deliberate was this? And what were the biggest internal hurdles, to convince a company with almost a century of tradition to pivot so dramatically?
That's a critical question. This evolution was indeed incredibly deliberate. It was born out of a recognition that simply being a middleman for parts, while stable, limited their growth potential and exposed them to margin compression from more commoditized competition. The biggest internal hurdles likely revolved around culture and capability. Imagine transforming a sales force accustomed to order taking into a team of technical consultants. It required significant investment in training, hiring new engineering talent, and building out specialized service centers. It also demanded a shift in mindset at every level, from what product can we sell to what complex problem can we solve for our customer. This pivot is central to their current performance and, more importantly, their future prospects. They're not just selling components anymore, they're selling comprehensive expertise and integrated problem solving. This strategic move up the value chain allows them to command better margins, build those stickier customer relationships we mentioned, and create a more defensible business model because they're addressing more complex, higher value problems.
That makes perfect sense. It's a very ambitious shift. Now, the report segments AIT's business into two key areas. First, there's the service center-based distribution. This sounds like their bread and butter, right? The foundational, more traditional side. Can you walk us through what this segment truly entails and why it's so critical to their overall strategy?
Absolutely. This segment is undeniably their foundational business, the bedrock that provides stability and consistent cash flow. It operates through a vast network of service centers spread across North America, focusing primarily on the maintenance, repair, and operations or MRO needs for an incredibly broad array of industrial customers. Picture a busy factory floor. You have bearings in every rotating piece of equipment that eventually wear out, power transmission components like belts and chains moving products along, industrial rubber products for conveyor systems, and a constant need for general maintenance supplies to keep everything running smoothly. The demand in this segment is largely driven by break-fix scenarios. If a critical machine goes down, it needs to be fixed immediately to avoid costly production downtime. This non-discretionary nature creates a very stable recurring revenue stream, making it highly resilient even during economic downturns. While in Q4 fiscal 2025, this segment saw a slight organic daily sales decrease of 0.4%, reflecting a generally muted industrial activity during that period. The management noted strong seasonal sequential trends, which really highlights its underlying stability and essential role even when the broader economy is facing headwinds.
So it's the reliable backbone, yeah.
Yeah.
Generating consistent cash flow that essentially keeps the lights on and funds their strategic initiatives even in tougher times. It sounds like the kind of business that provides stability, but perhaps not the explosive growth that investors often chase.
Precisely. It's the steady workhorse that provides the crucial stability and predictable earnings for the entire enterprise, allowing them the latitude to invest elsewhere.
Okay, now for what the report indicates is the more dynamic, growth-oriented side, the engineered solutions segment. This is where the transformation you described really comes to life, right? This is where they're not just distributing, but truly innovating and adding that deep technical layer. What distinguishes this segment and how is it performing?
You've hit the nail on the head. This segment is the strategic cornerstone for future growth and margin expansion. Unlike the transactional nature of the service center segment, Engineered Solutions offers highly specialized technical products and complex systems and high-value areas. Think about fluid power, which involves the transmission of power using sophisticated hydraulic or pneumatic systems in heavy machinery or manufacturing. Or specialty flow control, critical for precisely managing the flow of liquids and gases in chemical plants or pharmaceutical production. And of course, advanced automation encompassing robotics, machine vision, and sophisticated control systems that are transforming modern manufacturing. This business is inherently more project-oriented, requiring significant engineering design, customization, and extensive technical consultation, which is a stark differentiation from simply fulfilling a parts order. This is where they're building their true competitive moat. The big news that stood out from the report is that in Q4 fiscal 2025, Engineered Solutions reported a very encouraging 1.8% year-over-year increase in organic daily sales. Its first organic growth in 7 quarters.
Wow, 7 quarters.
Yeah. This was a primary driver of their better-than-expected overall results, signaling a significant strengthening of demand in key technical verticals and providing powerful validation for their strategic shift.
That's a powerful signal indeed. It sounds like the thesis of their transformation is starting to truly materialize in the numbers. So to distill it, the service centers provide that robust, stable base, consistently generating essential operating capital. And the Engineered Solutions segment provides the clear vector for higher margin growth, deeper customer integration, and ultimately driving the future value of the company. Is that the right way to think about it?
That's an excellent distillation. And building on that, their overall value proposition is built on 2 key pillars. First, immense product breadth. They manage over 9.2 million unique stock-keeping units, or SKUs, sourced from more than 4,000 manufacturers. This vast inventory makes them a true one-stop shop for an incredible range of industrial needs. But crucially, the second pillar, and their true differentiator, is their value-added technical services. They're not just providing a component, they're offering fully engineered systems tailored to specific customer needs. They provide deep technical customer support, comprehensive aftermarket repair capabilities to extend the life cycle of expensive assets, and specialized automation expertise, including robotics, machine vision, and digital technologies, all supported by over 30 dedicated technology locations. This comprehensive approach allows them to command stronger pricing power and build those stickier customer relationships because they're solving complex problems, not just selling boxes. And it's working. Impressively, 80% of their sales come from products where they hold a #1 or #2 market position, which really solidifies their pricing power and strategic importance to their customers.
That's a huge competitive advantage.
Right.
It's not just what they sell, but how they sell it, solving complex problems and building an ecosystem of solutions around the product, rather than just delivering a product itself. This makes them far less susceptible to simple price competition, I imagine. Let's zoom out a bit now to the broader market AIT operates in. Maintenance, repair, and operations, or MRO. How big is this market globally? What's driving it? And is it a sprawling ocean full of opportunity, or a quiet pond where growth is scarce?
It is unequivocally a sprawling ocean, but one with its own unique currents. This is a vast global market, currently projected to reach somewhere between $700 billion and over $880 billion by the early 2030s. So the sheer scale is immense. However, it's characterized by a relatively modest, low single-digit growth profile, typically ranging between a 2.3% to 3.8% compound annual growth rate. What this implies for a company like AIT is that achieving above-market growth often requires gaining market share from competitors, rather than simply riding a booming tide. It's also an incredibly fragmented market dotted with thousands of smaller, regional, and highly specialized players. This fragmentation, crucially, creates persistent opportunities for consolidation, a core pillar of AIT's growth strategy. And while the broader industrial sector is cyclical, MRO demand is notably more resilient during economic downturns because it's largely non-discretionary. Machines must be maintained regardless of the economic climate, otherwise production grinds to a halt, incurring far greater costs than the maintenance itself. This foundational, essential demand acts as a powerful stabilizing force for the industry.
So it's a massive, steady, but slow growth ocean, full of smaller fish where bigger, more strategic players like AIT can consolidate and grow. And, crucially, it remains relatively stable even when the broader economy is choppy. That's a powerful combination. The industrial world certainly isn't static, though. What major trends are currently impacting the sector that AIT is navigating? Are there some big transformative currents pushing the entire industry in new directions, perhaps even playing into AIT's strengths?
Absolutely. There are several powerful secular forces fundamentally reshaping industrial distribution, and AIT is strategically aligned with nearly all of them. First, Industry 4.0 and technology. We're witnessing the widespread adoption of the Internet of Things, IoT, sophisticated predictive analytics, and artificial intelligence, AI, across manufacturing. This isn't just buzzword bingo, it's genuinely shifting maintenance from reactive, fix it when it breaks, to proactive, anticipate and prevent failures. This elevates distributors who have deep technical expertise, like AIT, from mere suppliers to strategic partners. Then there's customer outsourcing of MRO and complex technical functions. Companies are increasingly seeking to offload these non-core activities to focus on their primary business, especially with the persistent shortage of skilled technical labor. This directly benefits value-added distributors who can fill that expertise gap. E-commerce and digitalization are now dominant channels, compelling even traditional distributors to invest heavily in robust online presences and digital capabilities. And finally, a huge tailwind is reshoring and supply chain resilience in North America. It's driven by geopolitical risks, trade tensions, and a desire for more secure, localized supply chains. Manufacturing operations are moving closer to home. This provides a significant secular tailwind for domestically focused distributors like AIT as industrial activity increases within their core operating regions.
These sound like more than just favorable trends. They sound like perfect tailwinds for a company focused on technical solutions and a strong North American presence. It's almost as if the market is moving right towards AIT's strengths, as if they foresaw these shifts and strategically positioned themselves years ago. What was the critical moment or insight, you think, that led management to pivot towards capitalizing on these specific secular trends?
Well, it probably wasn't a single aha moment, but rather an evolving understanding and strategic foresight. The insight likely coalesced from observing customer pain points, the growing complexity of industrial equipment, and the increasing shortage of skilled in-house technicians. Management recognized that simply being efficient at logistics and product delivery wouldn't be enough long-term. The critical pivot was understanding that information and expertise about how industrial assets operate, maintain, and integrate would become as valuable as the physical parts themselves. This led to conscious investments in engineering talent, specialized automation centers, and an acquisition strategy focused on technical capabilities, not just market share. It's a multi-year, deliberate effort to align with these macro forces, essentially building the future they wanted to operate in.
In such a vast and competitive landscape,
Yeah.
how does AIT truly stand out? What's their moat, that defensible advantage that keeps competitors from simply replicating their success or undercutting them?
AIT's most defensible competitive advantage, its moat, is multi-layered but primarily anchored in its deep technical knowledge and extensive engineering capabilities, especially within its engineered solutions segment. This expertise isn't easily replicable. It's built on years of experience and specialized training. It allows them to solve genuinely complex, mission-critical customer problems in sophisticated areas, like designing custom fluid power systems, integrating advanced robotics into a production line, or implementing machine vision for quality control. These are not generalist tasks. Secondly, their scale and network density with approximately 600 locations across North America provides an unmatched advantage. This localized inventory and rapid service capability are absolutely crucial for MR customers where every minute of downtime costs thousands, sometimes millions of dollars.
Because speed matters.
Exactly. Being able to deliver a critical part or send a technician quickly is a huge differentiator. And finally, their supplier and customer relationships, cultivated over decades with more than 4,000 manufacturers and deep integration with customers through their value-added services, create incredibly sticky relationships. These go far beyond mere price competition. They're built on trust, reliability, and demonstrated problem solving, making it incredibly difficult for customers to switch.
So they've consciously found a defensible niche by becoming expert problem solvers, rather than just generalists. They've avoided being stuck in the middle by choosing value-added differentiation, carving out a specialized corner of the market where their unique skills are highly valued. That's a very smart strategic move, especially in such a crowded space. Let's place AIT within its competitive universe. How does it stack up against some of its big-name peers like W.W. Grainger, Fastenal, and MSC Industrial? Are they all playing the same game, or does AIT have a fundamentally different strategy that sets them apart?
That's a critical comparison to make. When we look at the numbers and strategies, AIT, with its approximately $4.5 billion in FY24 revenue and a market cap of around $10.2 billion as of September 2025, is a significant industrial player. However, it operates on a different scale than the absolute broadline behemoths like W.W. Grainger, which posted $17.2 billion in FY24 revenue and boasts a market cap nearing $48 billion. Or Fastenal, with an estimated $7.5 billion in FY24 revenue and a massive market cap of approximately $55.0 billion. AIT is larger than MSC Industrial, which had $3.74 billion in LTM revenue and a market cap of about $5.1 billion, making MSC a more direct competitor in certain MRO segments. Grainger is renowned for its immense scale, incredible logistics prowess, and a highly successful e-commerce presence epitomized by its Zoro.com platform. Fastenal, on the other hand, has built a formidable competitive moat through its unique on-site inventory management model, where they place vending machines and entire supply solutions directly within customer facilities.
Yeah, that on-site model is really something.
It creates exceptionally high switching costs for their clients. MSC Industrial focuses heavily on metalworking and MRO products and services, with a strong emphasis on service and technical expertise in those specific niches. AIT differentiates itself with its pronounced focus on high-value engineered solutions, particularly in fluid power and advanced automation. While they maintain a strong MRO distribution business, their strategic pivot emphasizes becoming the go-to partner for complex technical challenges that require bespoke engineering and integration. This places AIT strategically between the broadline giants who focus on sheer breadth and speed and the highly niche specialists. It's a classic strategy of carving out a strong position based on specialized value, rather than trying to outcompete the giants on their terms of sheer breadth or unique delivery models like Fastenal's on-site model. They're playing a smart, differentiated game, leveraging their specific strengths.
It certainly sounds like they're playing a smart game, not trying to out-Grainger, but instead leveraging their specific strengths and technical expertise to create a compelling and highly defensible position in the market. It's about being the best at what they do, rather than the biggest at everything. This targeted approach seems to be working for them. All right, let's talk money. How has AIT's financial performance been, especially with this multi-year transformation underway? Are we seeing the tangible fruits of their strategic labor reflected in their numbers, particularly given the challenging industrial backdrop you mentioned?
The financial performance has been remarkably resilient and, in many aspects, truly impressive, especially when you consider the broader industrial context. For fiscal year 2025, AIT achieved record net sales of $4.6 billion, representing a 1.9% increase over the prior year. What makes this particularly notable is that it happened despite a challenging industrial backdrop, which actually led to a 2.3% decline in organic daily sales for the year.
Ah, interesting.
This clearly indicates that their top-line growth was entirely acquisition-driven, demonstrating the effectiveness of their M&A strategy. But what's truly outstanding is their profitability. They reported record net income of $393.0 million and diluted earnings per share, or EPS, of $10.12, a solid 3.8% increase over the prior year. A significant milestone highlighted in the report is that they achieved a gross margin beyond 30% for the first time in their nearly 100-year history, reaching 30.3% in FY25.
Over 30%. Wow.
Yeah, it's a big deal. And this isn't accidental. It directly reflects a favorable sales mix, shifting steadily towards their higher margin engineered solutions, coupled with highly effective cost management across the organization. Looking at a longer trend, over 5 years from fiscal 2020 to 2025, they've expanded gross margins by a healthy 130 basis points and EBITDA margins by an impressive 330 basis points. This showcases consistent, disciplined profitability improvement, proving they can enhance margins even when facing external economic headwinds.
So they're growing earnings faster than sales, which really points to strong operational leverage and smart margin enhancement. It means they're not just selling more, they're selling smarter and more profitably, effectively re-engineering their profit engine, even when the broader market isn't booming. For a company in a traditionally mature industry, achieving margin expansion while organic sales are down is quite a rare feat.
That margin expansion story is indeed crucial, and the recent quarterly segment performance perfectly illustrates how their hybrid model is executing this strategy. As we discussed earlier, Engineered Solutions delivered a strong 1.8% organic daily sales growth in Q4 FY25. This was a critical inflection point, reversing that multi-quarter decline, and it directly drove the overall earnings beat. Management noted solid execution, capitalizing on recent order momentum, and firming demand in key technical verticals like technology and advanced automation. On the other hand, the service center segment, while facing the broader industrial slowdown with that 0.4% organic daily sales decline, was characterized by management as holding steady against the muted end market backdrop. This validates their hybrid approach. The growth engine in Engineered Solutions is firing, driving higher value and future potential, while the staple core of the service centers holds firm, providing predictable cash flow and offsetting some of the cyclical pressures. It's a very intelligent balance.
It truly is like having a reliable, powerful engine providing consistent operational power and a high-performance booster rocket that kicks in for accelerated growth, all working together to achieve impressive overall results, even through economic turbulence. It sounds like a well-oiled machine. Beyond just top-line sales and profit, how efficiently are they using their capital? Are they simply making money, or are they consistently making smart investments with the money they generate, truly creating value for shareholders?
They are absolutely making smart investments, and the numbers bear that out definitively. AIT consistently generates strong returns on capital, which is one of the most important indicators of an efficient and profitable business model that creates real value. Their return on equity, or ROE, was a robust 22.24% in the most recent trailing 12-month period.
22%, that's strong.
Very strong. And their return on invested capital, or ROIC, was an impressive 16.93%. These are not just good numbers, they are high returns that consistently indicate efficient capital deployment, well above their estimated cost of capital. Essentially, for every dollar of equity or capital they employ in the business, they're generating a significant return, highlighting that they are creating value, not just growing. Furthermore, their book value per share has more than doubled, increasing from $24.21 in fiscal 2021 to $48.71 in fiscal 2025, which further validates their history of effective capital stewardship and consistent value creation for their owners.
These are seriously impressive numbers. It means they're not just profitable, but they're incredibly efficient with their capital, which is exactly what you want to see from a well-managed company that's in a growth phase. And what about their balance sheet and overall cash flow? How strong are they, especially considering the acquisitions they've been making to fuel this transformation? Is this growth financially sustainable, or are they stretching themselves thin?
Far from stretching thin, AIT maintains a strong and highly flexible balance sheet, which is a key strategic asset that provides a solid foundation for their growth ambitions. As of June 30th, 2025, total assets stood at $3.18 billion against a remarkably conservative total debt of $570 million. This results in a very low total debt to equity ratio of 0.31, which is considered exceptionally healthy in this industry.
Very low, yeah.
This conservative leverage provides substantial financial flexibility for future strategic initiatives, including further M&A, without burdening the company with excessive risk. But perhaps the most compelling aspect of AIT's financial profile is its powerful cash flow generation. In fiscal 2025, they generated a record $465.2 million in free cash flow.
Record free cash flow.
Record free cash flow. This is a remarkable 34% increase over the prior year, and it's particularly impressive when you remember that this was achieved despite negative organic sales growth during the same period. This highlights two crucial points. First, excellent working capital management, demonstrating their discipline in converting sales into cash. And second, the inherently cash-generative nature of their distribution business model. This strong, predictable free cash flow is the lifeblood that fuels their capital allocation strategy, enabling them to fund strategic acquisitions, support their dividend, and execute share repurchases, all without relying heavily on external financing.
Wow, generating record free cash flow, even with negative organic sales growth. That's a true sign of operational discipline and a robust business model. It means they're not just profitable on paper, but in actual, tangible cash, which gives them immense power for reinvestment and ultimately shareholder returns. That's a very reassuring signal. So AIT isn't just relying on external factors like market growth for their future. What are their internal organic growth initiatives? How are they actively growing from within rather than just buying growth?
A key internal initiative, which is both clever and highly effective, is the aggressive cross-selling of their expanded technical offerings. We're talking about their specialized solutions in fluid power, flow control, and advanced automation, now being pushed through their extensive service center network. Think about it. They already have thousands of established relationships through their MRO business, built on years of trust.
Right, leverage the existing network.
Exactly. The strategy is to leverage those existing relationships. These are literally feet on the street and established customer accounts to introduce higher value, more complex, and ultimately more profitable engineered solutions. This aims to significantly increase their wallet share with existing customers, making each customer account more valuable without the high cost of acquiring completely new customers for their specialized solutions. It's a very smart, efficient way to leverage their foundational business for deeper engagement and higher revenue per customer. They are turning a transactional relationship into a consultative partnership.
And externally, they seem incredibly well aligned with some major industrial trends. It's almost like they're perfectly positioned to surf some really big waves in the industry. Tell us more about how they're capitalizing on these powerful secular tailwinds that are reshaping North American manufacturing.
They are indeed strategically positioned for several powerful, long-term secular tailwinds that are fundamentally reshaping the North American industrial landscape. First, and this is a significant one, is manufacturing reshoring to North America. As companies globally seek to reduce geopolitical risks, shorten supply chains, and enhance resilience, they are bringing manufacturing operations back home or closer to home. This directly expands AIT's addressable market as domestic industrial activity increases, driving demand for both MRO services and engineered solutions. Second, aging infrastructure across North America. Whether it's factory equipment, power grids, or transportation systems, older infrastructure inevitably drives higher maintenance and repair needs. This boosts their MRO break-fix demand, which, as we discussed, provides that stable, resilient core. And third, the accelerating adoption of automation and IoT, the industrial Internet of Things.
Yes, automation and IoT.
Creates significant demand for AIT's specialized technical expertise and advanced product offerings. Customers are investing heavily in automation, robotics, and smart technologies to improve productivity, enhance quality, and address persistent labor shortages. For example, their technology vertical, which serves high-growth areas like data centers and semiconductor manufacturing, actually contributed approximately 100 basis points to their consolidated organic growth in Q4 FY25 alone.
A full percentage point just from that.
Right, clearly demonstrating the real-world impact of these trends on their business. It's not just a theoretical benefit, it's translating directly into growth.
It's like they've built their entire strategy around what the future of North American manufacturing demands. They're not just reacting to these trends, but actively positioning themselves to be at the forefront of the solution, which is incredibly insightful and proactive. It seems like a very difficult strategy for competitors to quickly replicate. We heard earlier that acquisitions are absolutely crucial to their growth algorithm. What's their M&A strategy specifically? Is it just about getting bigger, or is there mere strategic, qualitative rationale behind their purchases?
M&A is undoubtedly a core pillar of their growth algorithm. Given the highly fragmented MRO and industrial solutions market, consolidation opportunities are abundant. However, AIT's approach is far from indiscriminate. It's highly strategic and disciplined. They focus intently on acquiring companies that fundamentally add critical technical capabilities, expanding their product and service depth in high-value areas like fluid power or automation. They also seek acquisitions that expand their geographic reach into key industrial hubs where they might be underrepresented, or provide entry into attractive new end markets with long-term growth prospects. It's about strategically enhancing their solutions portfolio and deepening their technical moat, not merely getting bigger for the sake of it. Each acquisition is carefully chosen to bolster their ongoing transformation into a higher margin, technically focused solutions provider, ensuring it's accretive to both earnings and strategic capabilities. Due diligence is rigorous, and integration success is paramount.
And they had a particularly big one recently, didn't they? That sounds like a perfect, tangible example of their strategy in action, a major acquisition that truly accelerates their transformation.
Fiscal 2025 was indeed significant for their M&A strategy, headlined by the acquisition of Hydradyne, LLC, which was their largest deal in 6 years.
Hydradyne, okay?
Hydradyne is a major distributor of fluid power and motion control solutions. This acquisition substantially strengthens AIT's engineered solutions segment, adding significant expertise, market presence, and customer relationships in a critical, high-value technical area. The initial results are highly encouraging. Management reported that the integration is exceeding expectations, with accelerated synergy realization and a strong contribution to EBITDA. To put it in perspective, in Q4 FY25 alone, acquisitions largely driven by Hydradyne contributed a significant 6.5 percentage points to total sales growth.
6.5% just from acquisitions in one quarter.
Exactly. This provides strong, tangible evidence of management's capability in not only identifying and acquiring strategic businesses, but also seamlessly integrating them effectively to create immediate and long-term shareholder value. They aren't just buying companies, they're making them better, integrating them into their existing network, and leveraging them to expand their strategic vision.
That's a truly tangible example of their strategy in action, demonstrating that they can not only acquire companies, but successfully integrate them for real impact and financial benefit. That's a crucial distinction.
Expanding on their strategic vision, AIT has made very targeted investments in high-growth technology sectors. They currently operate over 30 dedicated locations specifically for advanced automation solutions, covering cutting-edge areas like robotics, machine vision, and motion control, which collectively delivered mid-single-digit organic growth in Q4 FY25.
Yeah.
They're also leveraging their engineering expertise for emerging opportunities, such as the transition to electric-powered fluid power systems in mobile equipment.
Ooh, interesting. Electric fluid power.
Yeah, it's a fascinating area of innovation with massive potential for efficiency gains and environmental benefits. However, one area where the material provided less detail, and which remains an important lingering question for the future, is on their specific e-commerce and broader digital initiatives, especially when compared to competitors like Grainger's highly successful Zoro.com, which has become a significant digital storefront for a vast array of industrial products. While their focus on high-touch technical solutions is critical, the digital channel is increasingly vital for reach and efficiency. It's a key area to watch for future development.
That's a very insightful point. Investing in cutting-edge tech and advanced automation solutions is absolutely key for the future. But the digital storefront and overall e-commerce experience are increasingly vital for any distributor, even for highly technical products.
Yeah.
It's almost a foundational element now, isn't it?
And underpinning all of this is a highly capable management team. The executive team, led by President and CEO Neil A. Shrimshire, has articulated and consistently executed a clear strategic vision built on 3 core pillars: technical differentiation, operational excellence, and disciplined capital deployment. Their performance over the past 5 years strongly supports this narrative. They've delivered compounded annual growth for EBITDA of 14% and for EPS of 22%, respectively,
22% EPS growth compounded. Very nice.
alongside significant and sustained margin expansion. Their guidance for fiscal 2026, which explicitly acknowledges ongoing macroeconomic uncertainty, is described as a prudent approach, suggesting a conservative and realistic view, while remaining confident in their long-term strategy. This track record of strong execution and credible communication indicates a high-capability management team that is effectively navigating a complex industry.
So to summarize, they have a remarkably clear plan, they're executing it exceptionally well, and it's built on a repeatable cycle. Strong free cash flow from their stable core business funding strategic acquisitions of technical capabilities, which are then cross-sold through their extensive existing network, creating a powerful, self-reinforcing growth flywheel. That's a solid blueprint for sustainable success. It truly sounds like they've cracked the code for consistent value creation in a traditionally mature industrial sector. Now, for the big question on many people's minds, how is AIT currently valued in the market, and what does that tell us about how the market perceives its transformation and future potential? Is it fully priced in, or is there still an opportunity for re-rating?
As of September 2025, AIT's trailing 12-month, or TTM, price-to-earnings PE ratio is approximately 26x. This is notably higher than its 19.4x PE in FY24 and above its 3-year average, though still below its longer-term 10-year average, which had some noise in it. When we compare it to its peers, its PE is similar to W.W. Grainger at around 25.2x and MSC Industrial also around 26.0x. This suggests the market currently values them in the same class of high-quality, well-managed traditional industrial distributors. However, and this is where it gets interesting, AIT still trades at a substantial discount to Fastenal's impressive, call it 46x PE.
Wow, 46x, big difference.
Yeah, huge gap. The significant valuation gap reflects the market's premium reward for Fastenal's unique on-site inventory management model and the exceptionally high customer switching costs it creates. So while the market acknowledges AIT's quality, stability, and operational strength, it hasn't yet awarded it the same kind of premium valuation for its strategic transformation into a higher value solutions provider, at least not to the extent seen with Fastenal's distinct business model.
So the market acknowledges AIT's quality and perhaps its stability, but perhaps hasn't fully priced in the long-term value of its strategic transformation compared to some other industry leaders. It's almost like they're still being judged predominantly by their old identity, despite the clear shift towards a higher margin, more technically focused future. That implies potential upside if they continue to execute, doesn't it?
That's a fair assessment. The TTM PE of 26x certainly implies market expectations for steady earnings growth and continued high profitability, recognizing their operational strengths. Their enterprise value to EBITDA, multiple of approximately 16.9x, is also quite reasonable for a healthy, well-managed industrial company. But perhaps the most compelling valuation metric, especially for a cash-generating machine like AIT, is their free cash flow, or FCF, yield. This stands at approximately 4.6% based on their record FY25 FCF of $465.2 million and their current market cap.
4.6% yield.
Yeah.
So
Right. This represents a solid and tangible return on the market's valuation, directly highlighting their strong, consistent cash-generating capabilities. This robust FCF provides a foundational floor to the valuation and is the essential fuel for their ongoing capital allocation strategy, which drives future growth and shareholder returns. It's real money.
that strong free cash flow yield is a powerful indicator. It's real money directly flowing back to the company and its shareholders, which definitely lends confidence to its financial health and future prospects, regardless of where the PE multiple sits today. It's a very tangible measure of value. Every investment, no matter how promising, carries its own set of risks. What are the main challenges and potential headwinds AIT faces as it continues its journey? What should we be keeping an eye on?
That's absolutely right. No company is immune. AIT's business model presents a fascinating duality. It's intrinsically linked to the broader industrial economy, meaning cyclical risks from fluctuations in industrial production and manufacturing activity are always present. The negative 2.3% organic daily sales growth in FY25, reflecting that muted industrial backdrop, is a clear recent example of this vulnerability. Management's FY26 guidance explicitly factors in ongoing economic and interest rate uncertainty, particularly through the first half of the year, acknowledging this persistent risk. However, they possess significant defensive characteristics that mitigate some of this exposure. As we discussed, approximately 70% of their sales are from non-discretionary MRO break-fix demand.
Right, that's 70% buffer.
Exactly. This provides a stable revenue base because machines simply must be maintained. Their ability to generate record free cash flow and expand margins in a weak sales environment in FY25 is a powerful defensive trait, showcasing remarkable operational flexibility and disciplined cost management. So it's a constant balancing act between cyclical exposure and inherent resilience.
So while they're not entirely immune to broader economic downturns, they certainly have a strong safety net due to the essential nature of their core business, providing a degree of resilience that many other industrial companies might not have. That provides a significant buffer.
Exactly. However, the market is intensely competitive, and these pressures are ongoing. They face pressure from large-scale competitors like Grainger and Fastenal, which leverage immense scale, sophisticated logistics, and unique business models. They also contend with agile, specialized regional players who have deep local relationships and niche expertise. Furthermore, technological disruption from digital native distributors and B2B e-commerce platforms like Amazon Business also poses a long-term threat. These platforms could potentially disintermediate traditional distribution models and exert downward pressure on industry-wide gross margins if incumbents cannot sufficiently differentiate through high-value added services. Operationally, as a major distributor, they are inherently exposed to supply chain vulnerabilities, relying on over 4,000 suppliers. Broad disruptions, geopolitical conflicts, sudden trade policy shifts, natural disasters, can lead to product shortages, extended lead times, and increased costs.
Yeah, we've seen plenty of that lately.
Indeed. As recent global events have vividly demonstrated, while AIT's revenue is broadly diversified across many end markets, a broad-based or prolonged downturn in key customer sectors like industrial machinery, primary metals, or energy would inevitably impact performance. It's a complex web of risks that requires constant vigilance and adaptation.
It certainly sounds like while they've built a strong moat based on technical expertise and a broad network, they absolutely cannot afford to be complacent, especially with the rapid evolution of the distribution landscape and those ever-present supply chain threats. Constant adaptation and strategic foresight are clearly key. So, after this incredibly thorough deep dive into applied industrial technologies, what are the absolute biggest, most important takeaways for us? What's the essential story we should all be keeping in mind?
The essential story is one of successful strategic transformation. AIT's competitive advantage is highly sustainable, rooted in deep technical expertise and a deliberate focus on value-added engineered solutions. This isn't just a bigger version of what they were, it's a fundamentally different, more resilient kind of moat than mere scale or unique delivery model. This allows them to solve truly complex problems and build incredibly sticky customer relationships that go far beyond simple transactional exchanges. They also exhibit a balanced profile of cyclical exposure, tempered by significant defensive characteristics, with that 70% of sales coming from non-discretionary MRO demand, providing a stable, predictable revenue floor. Crucially, management's execution has been highly effective, demonstrated by a strong track record of impressive EPS growth, significant margin expansion, and successful value-accretive M&A like Hydradyne.
That's a powerful summary. Looking forward, what are the potential game changers, both positive catalysts and potential negative headwinds that could really shape AIT's trajectory in the coming years? What should we be watching for?
On the positive side, potential catalysts include a sustained cyclical rebound in North American industrial production, which would provide a significant tailwind. Continued successful, value-accretive M&A, consistent with their strategic focus, could accelerate both growth and potentially lead to further multiple expansion. And the acceleration of those secular trends we discussed, manufacturing, reshoring, and automation adoption could drive sustained, above-market growth for AIT's specialized segments, potentially leading to a significant valuation re-rating by the market. On the flip side, headwinds could include a prolonged industrial downturn, persistent margin compression from inflation or increased price competition, M&A integration risks if a big acquisition falters, and persistently high interest rates impacting customer capital expenditure decisions. It's a dynamic balance. To tie it all together, the current valuation of approximately 26x PE, while reasonable, still recognizes AIT primarily as a high-quality, well-managed industrial business, pricing it largely in line with its traditional distribution peers. This reflects the company's strong fundamentals, solid returns on capital, and consistent cash generation. However, it doesn't yet seem to fully incorporate the potential upside from its strategic transformation. The market, in essence, hasn't yet awarded AIT a full premium for its successful pivot to higher growth, higher margin engineered solutions.
Right, unlike Fastenal.
As evidenced by that significant valuation discount relative to Fastenal, the investment question ultimately hinges on whether management can continue to execute this strategic shift, consistently demonstrating its value and unlocking further value not yet fully priced into the stock.
So it's a company with an incredibly strong foundation, a clear, well-articulated vision, and a management team that's proven they can execute against that vision,
Yeah.
even through challenging economic times. The market might just be starting to fully appreciate what they're building, a fundamentally transformed, more resilient, and higher value industrial player. That's a truly compelling story to watch unfold.
This deep dive into AIT really highlights how even in established, mature industries, true, sustainable competitive advantage can still be forged, not just by doing things better or more efficiently, but by fundamentally transforming what you do and how you deliver value. It raises an important question for us all, both in our professional and personal lives. In what areas might we be holding on to a traditional model or a conventional approach when a bolder strategic shift could unlock significantly higher value, greater resilience, and maybe more profound impact?
That's a truly thought-provoking idea to leave us with. What stood out to you from our deep dive into applied industrial technologies? Were there any specific aha moments about how industrial companies are evolving, or perhaps how strategic vision translates into financial success? We'd absolutely love to hear your insights, your questions, or any areas you'd like us to explore further. Send us your thoughts. We're always curious to hear what you're thinking about. And if you have another stack of sources you'd like us to plunge into, send them our way. Until next time, keep digging, keep learning, and stay profoundly curious.